Hi, everyone. Welcome to another recording of the Jensen Summit Series. We're going to talk about investment themes and how they impact the businesses and the stocks within our portfolios. My name is Alan Bond. I'm portfolio manager on our quality growth and quality global strategies. I am joined today by Tira Pratt, who is a portfolio manager on our quality midcap strategy, and Jonas Fingberg, an analyst on quality growth and global quality growth. We're going to start today with some personal introductions, just so everyone knows who is talking to them. I'll start, and then I will pass the proverbial microphone around the room. My name is Alan Bond. As I mentioned, I started at Jensen in 2007 as an analyst to support our quality growth strategy. And 17 and a half or so years later, I'm still an analyst that supports quality growth, but now also covers companies across all three of our strategies as an analyst. Additionally, as I mentioned, I'm a portfolio manager on quality growth and global quality growth. Also head of research across all the investment strategies here at Jensen. Prior to joining Jensen, I was mostly on the fixed income side of the business as a high yield bond and corporate bond analyst. With that, I'll turn it over to Tira to talk about her background.
Yeah, hi, I'm Tira Pratt. Like Alan said, I am a portfolio manager on our quality midcap strategy. I had been at Jensen for about 7 years, and my whole time here have supported the midcap strategy. Prior to Jensen, I worked in alternative investments as well as consulting firms.
All right, my name is Jonas Fingberg. I have been an investor for around 15 years by now, previously working for firms in London, Bermuda, and Hong Kong. I have been at Jensen for about 2 years now, supporting the quality growth and global quality growth strategies.
Okay, well, thanks, guys. Well, with that, we will turn it over here to talk about some different topics that we see impacting various companies across the portfolio. And the first topic we want to talk about is interest rates. And in particular, the expectation that interest rates, or at least the Fed funds rate, is likely to be cut here. Interest rates have been high. They've been high for quite some time, and that's had an impact on the economy. And one of the most impacted sectors of the economy is the housing market. And we do have 3 stocks in the quality growth portfolio that are exposed to housing market activity. Those are Equifax, Home Depot, and Sherwin-Williams. And housing activity has been relatively muted here the past year or so. And in fact, if you look at mortgage application activity is kind of a proxy for housing market activity. That would imply that activity is near a 30-year low. You have to go back to sometime in the 1990s to find mortgage activity as low as it is today. And that's had an impact on those businesses. You know, Equifax has a massive amount of data that is used to make consumer lending decisions. Home Depot sells supplies for homes, which we need all the time. But if there's more housing activity, there's more demand for those products. And Sherwin-Williams sells paint, and in particular sells paint to professional painters and professional contractors. And you know, those projects can be ongoing, but typically will be higher if there's more housing turnover. So all 3 of these businesses are impacted by interest rates. They're impacted by trends in the housing sector. They've actually all held up relatively well. But we do think that if rates decline and the housing market picks back up, these businesses could be poised to benefit from those trends, given the strength of their market positions and the demand for those products if housing market activity ticks higher. With that, I wanted to turn it over to Tira. I know she's got some thoughts and examples of quality midcap companies that also have exposure to changes in interest rates.
Yeah, thanks, Alan. So another area, I think it's interesting to think about that's sensitive to interest rate cuts is biotech funding. So if you go back to 2021, we're kind of in that COVID boom of innovation focused on vaccines and antivirals. Interest rates are at all-time lows. Biotech funding was, it peaked. It's the highest it's ever been. Going into 2022 and 2023, obviously interest rates are higher, combating high inflation. There's some macroeconomic concerns. It did a complete 180, and now it's, some of the lowest it's ever been. I think it's back to 2015 or 2016 levels. So we really have lost almost 8 years of kind of funding innovation. So this has significantly impacted companies that are kind of in the early stage cycle of research. So if you think about how this impacts the lower funding and higher cost of debt, how it impacts a biotech company. So obviously it's going to be increased cost of debt. There's going to be lower VC or private equity funding, just given the outsized risk of some of these smaller biotech companies that are now levered up. And there's also going to be a significant impact to the profitability of biotech companies, leading to financial strain, lower R&D activity, and higher bankruptcy rates. So some of the companies that we hold in the mid-cap strategy, these biotech firms are the clients of these companies. So one example I can kind of walk you through is Charles River Laboratories. So Charles River is a non-clinical contract research organization that provides essential products and services to both pharmaceutical and biotech companies. So they primarily play in drug discovery and safety assessment, and they also provide research models for experiments, and they have a small manufacturing business. So about a quarter of Charles River's revenues is directly tied to what they classify as pre-commercial biotech, which is just a startup biotech firm that typically has less than 2 years of cash on hand. And so as these clients are either going through bankruptcies or just don't have the funds to support the drug discovery process to have, as much going on, Charles River has taken a pretty significant hit on the top line. I think the thing that's important to remember, as this funding isn't going away, it's just kind of in a lull right now. It's going to come back. If you think about the biotech industry, it's crucial for advancing healthcare and improving human lives. So it's playing a critical role in discovering and developing new drugs.
Okay, thanks, Tara. I think with that, let's move on to our next topic. And it's a bit related, or maybe a lot related to the first topic, which is about the consumer and consumer spending and the health of consumer spending. And we've seen some increasing sluggishness in consumer spending across many of the companies that we follow. And that is logical in the sense that if interest rates are higher, that means debt coverage and debt financing costs are higher. And those higher debt financing costs tends to crowd out other forms of spending. And so we've seen some weakness in consumer spending across portfolio companies. And we've seen that in some of the really high profile companies that we own. Starbucks, Nike, we own those in both quality growth and global quality growth. Diageo, we own in global quality growth. And these are all leading global consumer facing companies that have called out consumer weakness for weaker than expected top line results for those companies. But we have seen some pockets where certain companies and certain brands have been resilient, and the slowdown in consumer spending really has not impacted the business all that much. And with that as kind of a backdrop, we thought it would be interesting to talk about one of our quality global companies, which is Hermes, versus some of those other consumer products companies that I mentioned. But another one that we follow on our bench that's a particularly interesting comparator to Hermes is Estee Lauder, in the sense that both are luxury goods. They're global luxury consumer good manufacturers. In theory, they should have a lot in common, but their fates financially and business-wise have been very divergent here in the past year or so. And I thought we could turn the call over to Giannis to talk about those companies.
Sure. Thank you, Alan. Let me start by sort of adding a point on the interest rate discussion, if I may, in the sense that, like Tara and Alan have said, they do impact, the interest rates, whether they're high or low, it does impact, many of our portfolio companies to a degree. But the flip side is also that in terms of our investment process, like we all know, we focus on the long term, the competitive advantages, the management teams, the moat the companies have, et cetera. So while it may impact the shorter term performance, both positively and negatively, the interest rate, I don't recall that many discussions here, like in our investment team, where we, exclusively, so to speak, focus on the interest rate. And it's just because, our investment style is really bottom up. And so we are not the experts in predicting on a macro level where interest rates will go. At the same time, we still live, in the real world and have to take into account, like my predecessor said, that the interest rate does impact, at least in the short term and sometimes longer, how some of these companies perform. Although it's usually not the reason why we would invest in a company. So while, Sherwin-Williams, as an example, may benefit from lower rates, we have invested in the company because of its management team, its historical track record, its competitive advantages. And I think that's relevant. I point this out because when we look at Hermes as a company, as a French luxury goods company that produces really high-end luxury goods like leather bags, famous leather bags that might sell for thousands and in some cases tens of thousands of dollars. Many of you will know Hermes maybe from airport stores where you can buy their ties, as an example, as a more sort of entry-level item from them. And what we have seen with Hermes is because the price point for many of their products is so high, and also because of the company's strategy, their sales have been very resilient. So if you look at the second quarter results, for example, sales were up 13%. That is a really different performance than, let's say, Estee Lauder that Alan mentioned, that has been very challenged business on many fronts. So in some ways, you can say, okay, great that we own Hermes, and great that Hermes has not been so impacted or not impacted at all, arguably, by a challenged consumer. And there are various reasons for it. It has to do with the high price point of the product. So the consumers they're not necessarily impacted by economic forces on a day-to-day basis. It has to do with a model where they have essentially a waiting list to buy some of their most coveted products. So in times of weaker demand, the company essentially calls up its loyal clients and says, hey, now you can buy this spec that you always wanted. Therefore, they basically have this tool of managing supply and demand in a more sustainable way. There are other reasons, the company is really long-term focused. And this brings me back to my point, how we really focus on the business fundamentals. Hermes, the big difference to other companies in the sector, also difference to Estee Lauder, but even, arguably other luxury goods companies is they really build a long-term relationship with their customers. So, for example, somewhat counterintuitively, that it did actually not increase prices as much as they could. A lot of other luxury groups have increased the prices a lot. Hermes did actually not do that. And that's because, they don't want to annoy their loyal customer base too much, and they charge a little bit more each year, but not too much. And that speaks to the long-term approach and long-term management strategy that this company has employed for decades. Now, quick point again on the interest rate discussion. So on the other hand, you look at Estee Lauder, more an entry-level aspirational product. I mean, $60 for a lipstick might seem outrageous, but the absolute price point is still relatively low. So it's a much more affordable sort of product range or aspirational one. And that one has been absolutely impacted by some of the forces that Alan mentioned in terms of higher interest rates, weakened consumer, especially in China for Estee Lauder, but similar dynamic. But the reason I keep coming back to this interest rate point is that in some ways now, if interest rates decline, you could almost expect Estee Lauder to bounce back quicker or may potentially even outperform Hermes, even though fundamentally in the long term, in our opinion, it's a much weaker business. And that's because Hermes has held up very well and will not necessarily get this extra boost from a few additional consumers that now feel like they can spend money again. Whereas Estee Lauder has been very weak. Now interest rates go down. Maybe the consumer is less challenged. As a result, the delta is basically bigger for Estee Lauder. The incremental buyer might grow faster at Estee Lauder, and actually, so in the short term, might well be that Estee Lauder actually outperforms. But for our strategy, we think about holding companies and owning them for many years into the future. So that's what I meant while we take into account what happens to interest rates. It's not the basis of how we invest.
Couple thoughts, I guess. I think the conversation about Hermes is interesting. You always think about elastic versus inelastic goods from an economic sense. And typically, the way I've always thought about that concept is that inelastic goods are goods that you need, goods that you cannot live without. So they tend to be things like healthcare or maybe some consumer staples type products. I think what we're seeing here, what you're talking about, is that there's actually, if you go to the very, very high end of the curve, you become inelastic again, but for different reasons, right? I don't think everyone necessarily needs the most expensive handbag in the world, but there's a subset, and it's probably a pretty small subset of the world, but meaningful one, where that demand essentially is inelastic because they can afford to do that. It doesn't really matter what's going on in the economy. And I think that's, to me, the interesting thing you talked about, the difference between Estee Lauder and Hermes is that Hermes is true and absolute high-end luxury. Estee Lauder is a little bit more aspirational. I think that's, to me, I thought the interesting takeaway there as you were talking through those two. The other thing I wanted to circle back on really quick, because I think you did a good job of kind of talking about the fact that, yeah, we can make a kind of a short-term macro call on companies that have exposure to interest rates in the housing market. But reality is the long-term investment thesis, the reason we own Equifax or a Home Depot or a Sherwin-Williams is not because of a short-term call on interest rates or the housing markets. It's really about the competitive advantages for those businesses. And I kind of mentioned those businesses have held up relatively well despite, a muted housing market. And, if you think about what they've been doing, what has caused that? Home Depot, right? Home Depot's top line's been weak. It's been down a little bit, but not down a lot, not down nearly as much as housing market activity has been down. And the reason for that is that because even in periods when people aren't moving and housing turnover is low, you still need supplies for your home. And Home Depot is extremely well positioned in terms of their assortment, in terms of their real estate, in terms of their brand and recognition in the marketplace, that there's resilience there and they've held up relatively well. Sherwin-Williams has actually grown. And they've grown at the expense of their competitors. They've taken share. Some of their competitors have had to retrench in certain markets. And as competitors have retrenched, Sherwin-Williams has used their financial strength, their competitive strength to actually play offense in certain of those markets. So they're, kind of investing counter-cyclically, which we think positions them very well when the market does turn around. And then same thing with Equifax. Equifax, they do sell a lot of their data to lenders that make lending decisions about home purchases, but not just that. And so they have a very diverse group of customers in terms of the type of lenders they serve. And that's allowed them, again, to outgrow their end market. So this is a company that these are, 2 out of the 3 have actually grown here, despite, you could argue, a pretty weak backdrop for them. And I think speaks to the power of competitive advantages there. So I thought that was an interesting point to circle back to. Last topic I wanted to talk about here was AI and the quote unquote AI trade. What we thought would be interesting to talk about is sort of how we're seeing, what we're hearing from the companies that we follow and how we're seeing AI being implemented across businesses. And, the reason it's an interesting topic is that right now, or so far, the AI trade or AI investment has really been focused on the building and the training of the AI models or the large language models. And really simplistically, the training of these models requires an immense amount of computing power and an immense amount of computing capacity. So that's really fueled. When you think about NVIDIA, NVIDIA has really been kind of the epicenter of the gold rush here with AI. And it's because they design the computer chips that are used to power the training of these models. And they dominate that space. And this has become a massive source of demand for them. So as the models are being trained, there's a lot of demand for their chips. Similarly, if you look at some of the semiconductor equipment companies that are involved in actually producing the computer chips, as the demand for computer chips has gone up because of the training of these models, the prospects for those businesses have gotten a lot higher. So it's been really more trade about chip manufacturing and semiconductor hardware, right? And we have a little bit of exposure to that in our portfolios, but most of what we've owned in tech is more focused on what we would consider stable and consistent and very well-positioned software businesses, right? We've seen some benefit from the AI trade, but maybe not as much as others because of our focus on the software businesses. But this brings us to the next conversation. Well, someplace there's a lot of investment being made in AI, and at some time we would expect to sort of see uses, and this is where we think the software companies may benefit. But there's been skepticism. We've seen increasing skepticism. This is, the return on investment, there's not been a lot of use cases for this. We're spending all this money building the models, but we haven't seen the use cases yet. And so we were kind of thinking, okay, so what use cases are we seeing? And where do we sort of see the roadmap, if you will, of how kind of these large software companies that we own and how they might benefit from that trend as we move forward down the development curve here with AI? And I guess I had a couple of thoughts here to start, and then I'll swing it around the table for Tira and Giannis to add thoughts, because I know they have some as well on this topic. So the best use case that I've seen across companies in our portfolio, or the most common one, is very data intensive businesses. And these are businesses where there's an immense amount of data, there's multiple data sets, and AI can play a big role in integrating those data sets and making the use of those data sets more efficient and more accurate, right? So a really good example of this is with pharmaceutical companies. A big part of pharmaceutical companies is early stage drug research, which Tira talked a little bit with Charles Rivers a moment ago. But in this stage, drug companies are sifting through a multitude of different drug targets and different proteins and protein combinations that they want to target. And then how's the best way to target that drug? And the amount of data that's involved in that is immense. And these companies are able to use AI tools to do that process and make it much more efficient, make it much more accurate, and improve the likelihood that some of these early stage drug efforts will result in actual drugs that are approved and are used and generate revenue in the future. And so this is one area where we've seen a lot of promise with AI applications and seen companies increasingly talk about it. The other is really data intensive businesses. And I mentioned Equifax a couple times earlier. Equifax is a really good example of this. Equifax has proprietary data. It's proprietary data that is going to help determine whether or not people are likely to be able to pay off loans if they're loaned money. They have payment data on things like credit cards. They have income data. They have employment data. They have wealth data. These things are all critical to making that determination of whether this person is creditworthy, right? Whether someone should loan them money. But these are disparate sources, right? So the Equifax owns this data. It's proprietary. It's unique. It's very highly valued. But they can use AI and AI tools to help integrate that data and to help make faster and more effective, more inclusive, more holistic decisions about lending. And that's an area where we've seen they started talking more and more about that. So we are seeing use cases, and it's kind of slow, but it's starting, and we think that might be an interesting next leg to the conversation here. Tira, do you want to talk? I know there's some companies you've talked about that do this as well.
Yeah, I'm gonna stick on the kind of more data intensive businesses using AI, and so I'm going to talk about ADP. And so ADP, just for quick background, is one of the largest providers of human capital management software and solutions. So they're dealing with a lot of data, a lot of employee data. They've talked about using AI kind of in two primary ways. One, they're embedding it into their products. So an example with that would be that they are using Gen AI to combining, extensive data sets with Gen AI and then automating routine tasks, providing insights, and then aiding decision making. And so that is helping make the products run smoother and helping the clients gain insights from that. They're also using it for internal operations. So similar to what they're embedding in their products for clients, they're again automating and streamlining their tasks. So one example they gave would just be digitally onboarding new clients. So they're taking in the unstructured employee data, and then they're reducing manual data entry and then minimizing risks of implementation errors. So this all really, I view it as low-hanging fruit of where AI can be applied immediately and have significant impact. So for ADP, it's less about them monetizing AI right now, but more about using it to improve their client experience. And for a company that relies on high client retention rates and client satisfaction, this has been, a really important part of their business, and they've seen a significant impact just on client happiness.
Thanks, Jared. So, Giannis, you're covering several of the companies that I talked about earlier with the outset of this conversation that are semiconductor equipment companies, a couple of which we own, KLA Corporation, we own ASML and the global strategy that you've done work on. And I know you and I've had a lot of conversations sort of about what does the future of AI look like and who are likely to be the winners. So maybe you can just kind of expand on some thoughts in that regard from your view.
Well, it's difficult. It's such a complex and broad topic and a lot of moving parts. I think you can certainly, you start to see increasingly cases of where AI is basically being used or becoming a requirement. So like one example would be software engineering. So I spent a lot of time in Silicon Valley, I guess. You can see certainly increasingly job postings for software engineers for coding, and will specifically say unless there is experience with using AI coding assistants, then you should essentially not apply if you don't have that experience. So there's certainly increasingly cases where in a very sort of tangible way, AI is making an impact in very specific areas. But at the same time, and we have all seen, use cases, of course, for years, I guess, already of like, auto suggest an email, or we have seen now the ability of, depending on which programs you use, summarizing text and so on. But my bigger point is that in some ways, you put this against the massive investments that go into the sector. And of course, it's very easy then to conclude, well, somehow there seems to be a disconnect. I mean, essentially, it's almost like the stock market has concluded that there's an infinite or at least a very, very large return on AI or knowledge. And in reality, the actual ways to make money from it right now are way more limited, even if we can all look at our companies and pick up an example here or there. Now, that probably does not mean that therefore AI is not here to stay. I mean, I believe very much that it's here to stay. The other day, I was at a talk where essentially the speaker was comparing it to electricity. So basically as a more sort of foundational technology that then as a second will enable the creation of many other sort of follow-on innovations that come from that, which I thought was an interesting way of thinking about it. But at the same time, if you look back at the invention of electricity and when it finally, became sort of available on a broad scale, it still at the time actually took a long time for it to truly lead to different work processes, to different products, to different ways of, let's say, transportation and so on. It took a long time even for such a technology that we take for granted today. Compared to that, actually, you could argue that, ChatGPT, it only took a couple of months to make an impact. So overall, it's a very dynamic field. Clearly, the key decision makers in Silicon Valley, by and large, have all decided that artificial intelligence is one of the, if not the most central technology over the next decade. That's why so much investment flows into it. And to Alan's point in the beginning, I would say that actually in some ways, that fits a Jensen strategy reasonably well in the sense, yes, okay, we could not own NVIDIA because it did not have ROE over 15% for a long time until the beginning of this year. And so it did not qualify for the universe of companies that we look at. So that's just a matter of fact. And in this case, maybe, it was a disadvantage, but there are many other cases where Jensen can point to where this rule of having this universe worked in the long-term favor of the clients. So I wouldn't be sort of too harsh on that in some ways, right? And then in other ways, if you look at, for various reasons, I mean, Alan mentioned, the massive amount of money that goes into investing into building these models. It's actually only, by and large, only the largest companies can afford those sums. And of course, quality growth is a very concentrated, large cap strategy that does own several of those companies that are more likely than others to eventually be the beneficiaries of that investment. I mean, Microsoft is an interesting case here, for example, right? If you look at the last results, actually the share price was relatively weak. And one of the key reasons is that the street did not like that Microsoft essentially said we're going to invest a lot more in chips. And, in some ways, that's a very short-term reason, right? Like, I mean, okay, maybe that doesn't lead to a return next quarter or the quarter after that, or maybe not even in a year. But what does that do in the long term for Microsoft, right? It will most likely continue to build its moat even further versus other companies that do not have the resources to invest in these technologies. So in that sense, again, like for Jensen's longer term approach, sometimes looking through those periods of where the market punishes a company because it seemingly invests too much in the short term can in the long term, in our experience, be beneficial.
Yeah, I think that the skepticism, if you will, that we've been reading about is more about near-term ROI. And I think what you're talking about is that the ROI might need to be measured over years and maybe even decades, not over, days and months and so forth. And that's
I think so, yeah.
Probably the big disconnect.
Absolutely, unless you're really one of the most direct beneficiaries that immediately benefit because somebody buys, your chip or your chip making equipment. But I guess on the application side, it might just take a longer period of time until those gains materialize. But that doesn't necessarily mean that they're less powerful or that therefore the technologies as such is just a short-term phenomenon.
Yeah, and I think it's an interesting point you make about high quality businesses and financially strong businesses that have the ability to make long-term investments, and they don't have to think about an immediate return on something. But if something is promising for the long term, they have the balance sheet strength and the financial strength to make these investments. And I think that's an interesting lens to look through. That ends our discussion here today in terms of topics. So we talked about interest rates, we talked about consumer spending, and then we talked about sort of where we see AI happening today and maybe a little bit of a roadmap for the future. I want to thank my colleagues here, Tira Pratt, Fingberg, for joining us here on the Summit Series. And with that, we'd like to thank all the listeners, and we will be back here sometime soon with the next recording. Thank you very much.